Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 129. On today's episode, we got to talk about NVIDIA and the AI revolution, but we're also going to talk about Warren Buffett and his annual letter to his shareholders and his touching tribute to Charlie Munger, among a lot of other things. A lot of things to cover this week. So get your mind right, and let's get to work.
You dropped this.
Well, hello. Welcome back to the podcast, everybody. I have to stay really close to this microphone. Otherwise, it just doesn't work as well. So, welcome back to the podcast. We're having a productive weekend this weekend. Took the CFA exam yesterday, ran a half marathon today. So that's why we're a little late on the recording of this. But thanks for coming back as always. And so let's talk about the market here. We got a couple big things to discuss. We have NVIDIA earnings, obviously, and the power that they are pushing, behind this market here. We also have Warren Buffett's annual letter that came out. We'll discuss that a little bit. But also, I just want to think about, I was thinking this past week that we've been doing this podcast long enough that we have seen the stock market go down from its highs in 2021. And we just dealt with the pain all through 2022. And then we have come all the way back up to new all-time highs here in 2024. And so I just want to take a moment and say congratulations for making it through your first, stock market correction and then recovery. And it's worth spending some time on because there are so many psychological, behavioral finance, things with that are so important. When you ride the market down and then see it come back up, and you're able to kind of mentally accept that's a kind of a normal thing for the market, it actually makes you a much better investor. So if you've been listening to this for a while, congratulations, you're a much better investor. It doesn't mean that it's going to be easier the next time it happens. It will happen. But knowing this, you'll be much more likely to invest more money, save more money the next time it goes down, when you see some of the companies that you really like get beat up. And it is kind of a normal thing. But as a new investor, if you are a new investor or even an old investor, it doesn't make it easier, but you do have a little bit more experience when you have gone through a stock market correction and then come out the other side and said, okay, things really do get a little bit better, even though sometimes they don't seem like it. So we have done pretty well over the last 18 months. I've had many of you, I've had phone conversations that I think are pretty neat, where somebody calls me, they tell me, hey, I started investing. I haven't sold anything. I haven't sold a share. I'm doing well. So not on this episode, but I think in the next couple of weeks, we're going to talk about how do you go about taking a profit. If you have some stocks that have done very well, and how do you protect the profits you've had. And so we will discuss that on a future episode. But now we'll talk about NVIDIA. NVIDIA's earnings came out this past Wednesday. That would have been on February 21st. And they had great earnings. Their revenue, which, remember, revenue is sales, were up 265%. Their data center business, which is just incredible, comprises the majority of their revenue. So their data center, is different than just the chips. And the data center grew 409%. And over half the company's data center sales went to large cloud providers. So think of names like AWS, which is Amazon Web Services, Microsoft. These are big time companies that are all doing business with themselves, trading this money around. And so it's a big deal. And so you look at NVIDIA, it's such an important report for the market and kind of this new push into AI. NVIDIA went past Google and Amazon this past week to be the third most valuable company in the world now. And so just pretty incredible. Jensen Huang, who is the CEO of NVIDIA, I think you'll like this story. They did a deal where, he used to work for Denny's. Yeah, he used to work for Denny's. I mean, this is like great American story here. Used to work for Denny's. There's a booth where he, was talking to his founders of NVIDIA, where they came up with the idea for NVIDIA, and they actually put a plaque. They put a plaque in the Denny's where, the booth that he was sitting in, where he came up with the idea for NVIDIA, which is just a tremendous, good American story. So you can look that up. Just type in NVIDIA and Denny's and it'll come right up. But just something to look at. And so you look at, NVIDIA doing all these amazing things. Again, other companies that we've talked about, if you haven't invested in NVIDIA, and now it's close to $800, price targets are moving to $1,100, $1,200 just based on the expectation. It's not even what they're doing now. I mean, it's the expectation for 2025. I mean, even NVIDIA, they're giving guidance for 2025. They say their foundries are running 24 hours a day, just making these things as fast as they can. But you got to remember, not everybody's going to be able to buy the NVIDIA chips. And, you can go look at a company like AMD, and that's their symbol, AMD. And, somebody's going to have to, hit that lower tier market or that mid-tier market. AMD is well poised to do that. Also, a company we've talked on this show about a lot is ASML. So ASML is they make the machines that you have to have in order to be able to manufacture these chips. And again, they're based in the Netherlands and they're going to be important. So again, kind of the same concepts we talk about a lot, which is you find a great product, kind of like the iPhone, and you find out what goes into an iPhone. Who are the companies making this or that or whatever, right? That was Skyworks Solution, ARM Holdings for a bit. ARM Holdings is now doing some AI stuff. So you look at NVIDIA, who's using them, right? So on the conference call, NVIDIA talked about ServiceNow, and they talked about, all the big companies, the Magnificent Seven that we've discussed, and they talk about who their partners are, just paying a little bit of attention. All right, right. We don't have to be the smartest people in the world to ride these coattails. And so you look at that, and to me, I'm like, okay, well, what can knock the market down? I always try to think about, when everything was bad, I'm like, what's going to bring the market up? Now I'm thinking, what could bring the market down? Well, a couple of things, obviously, is the election. But more important than that, like the economy is still humming pretty well. I mean, the Fed hasn't raised rates. We've had this expectation that they're going to lower them. There is no sign in the economy that people are slowing their spending, that there's any reason that that the Fed should cut rates. This week, the Fed is going to have one of their numbers come out. What's the name of this one? It's the personal consumer expenditures. So the PCE number, looking to see are people still spending money. The expectation is they are, but it's not going to be as much as it was last year. So maybe that's a good report, but there's just not a whole lot of data out there that supports the Fed lowering interest rates. And so obviously the election overhang is going to be part of it. But again, even with the election, as long as we still have split government, that usually is the best. Split government, if you're looking for a formula for good stock market performance, split government is it. If you go back 100 years, split government is the best result for the stock market over the past 100 years. So we look at that. We look at China's not doing well. We are having an infrastructure boom. If you look at some companies that could be, Ingersoll Rand. We talked about Nucor, the steel company, probably over a year ago. There's United Rentals. United Rentals is really good because companies that can't borrow a lot of money to buy equipment, they rent it from United Rentals, which looks good. Waste Management's been doing fantastic. Waste Management, one of their number one sectors is home building, so that looks good. And then you look at drug makers, you look at Eli Lilly and the weight loss drugs that are coming out there. So there's some, good things happening in the market that you need to pay attention to, and you need to be looking at and kind of adding to your portfolio. If there's some of these names that you wish you would have bought when they were lower, see, this is where investors get themselves into trouble. So again, if you remember anchoring bias, which is you get keyed off of one number, right? So you remember NVIDIA when it was, 200, 400, 600, whatever the number is, and you think, oh my gosh, I can't buy it at 800 because I remember when I should have bought it at 4. You cannot think that way. You have to think about, well, if they're going to go to 12, and I'm not saying they are. This is not a, expectation. I'm not, this is for entertainment purposes only. Remember, talk to your financial advisor. But if the expectation of them is, to you, if you look at the investment and you think that they could possibly go to $1,100 or $1,200, if you pass on them because you remember when they were 400 and now they're 800, don't make the same mistake twice. If you still believe in the company, you look at the numbers, it still looks like a good investment to you. You have to put that, the decision you made years ago or a year ago. You cannot let that impact your decision to invest in them now. So, and that's not just for NVIDIA, that's for all companies. And, you can always start small. You put a little bit into your portfolio. If they get beat up, there's going to be some political something. There's always going to be one or two news stories a year that we do not see coming that's going to bring the market down. And that's when you strike. That's when you invest in these companies after, a bad day. And, remember there was a week or two ago, the Dow Jones had their worst day since last March. And again, we talk about it over and over as well, that most of the good days in the market happen within 2 weeks of the worst days. That proved to be the case again. And so, don't just try to always time everything perfect. Just be in good companies. And if they're good companies and they get beat up, just buy a little bit more. So all the things that we've discussed, your behaviors don't have to change that much. It's just all about consistency and kind of keeping a level head. We gotta keep our emotional brain and our intellectual brain. We got to keep them separate and know which one we're using. So I wanted to also talk about this weekend. Yesterday, actually, Berkshire Hathaway's annual letter came out. You can just type in Berkshire Hathaway letter. It'll take you right to the Berkshire Hathaway site. You can click on the year. It comes right up. And this year was a little bit, it's a little bit of sadness, but also celebration for Charlie Munger. And Buffett wrote a letter to him, or a letter about him on the front. And before I say that, there's a book called Poor Charlie's Almanac that came out years ago. This is the 4th printing, but Charlie actually did some writing in this, and it's kind of been redone. They actually held off publishing it because of his death. And if you can't see it, obviously you're listening, but I'm showing it on the video version that'll be on YouTube. But pretty neat. Looking at some of this. It also has a recommended reading list in it, which I'm excited to look at. I picked it up at Barnes & Noble. I actually got their only copy, or the only one left, I guess. But going back to the letter, Warren Buffett says, right, that Charlie died 33 days before his 100th birthday. And he talked about how, Charlie was the architect of Berkshire Hathaway, and that Warren was the general contractor carrying out the day-to-day stuff, but Charlie was definitely the architect. And he's saying that he hopes that's what his legacy is when, moving forward, that people think of him as the architect of Berkshire Hathaway. And he says, in 1965, after Warren had bought Berkshire Hathaway, which at the time was just kind of a mill in the New England that was not doing very well, he said to Warren, forget about ever buying another business like Berkshire. But now that you control Berkshire, add to it wonderful businesses purchased at fair prices and give up buying fair businesses at wonderful prices. In other words, abandon everything you learned from your hero, Ben Graham. It works, but only when practiced at small scale. And so, Buffett and Munger, you can look it up. We've discussed this. I mean, they had such a wonderful relationship. But when you look at the Berkshire Hathaway letter, I wanted to point out a couple things that I thought were significant. Actually, just one. I just want to point out one thing, trying to read this and stay close to the microphone, which is fun. This is good times. And he's talking about, if you read this, it'll be on page 7. As he says, occasionally markets and or the economy will cause stocks and bonds of some large and fundamentally good businesses to be strikingly mispriced. Talking about 2008, could be 2020, right? You don't know when they're going to happen, but it will happen. And saying that you have to be able to respond and use money to buy these up. And he says, and I thought this was so interesting, though the stock market is massively larger than it was in our early years, today's active participants are neither more emotionally stable nor better taught than when I was in school. For whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. The casino now resides in many homes and daily tempts the occupants. And so, this just reiterates that most investors own a stock for 6 months. 6 months. In 1996, it was 6 years, and now it's 6 months, right? So we can trade on our phone. We can do whenever. We can get in, get out. It's just devastating to your portfolio if you do that. One fact of financial life should never be forgotten. Wall Street, to use the term in its figurative sense, would like its customers to make money. But what truly causes its denizens' juices to flow is feverish activity. At such times, whatever foolishness can be marketed will be marketed, not by everyone, but always by someone. And so, there will always be companies and people and advisors and whoever, insert another word here, that will try to get you to increase the level of activity. The only activity that you should really have in the market is just investing constantly. The activity should be on the buying side, not on the selling side. Activity should be on the buying side, not on the selling side. And, to partner this with the way I always close the podcast, which is never mistake activity for achievement. You can use that for your daily life, and you can also use that for your investing life. So we feel good when we sell things and we buy back and we feel like we have all this activity and we've done something. But sometimes it's just like walking around the block and all of a sudden we're exactly where we started, right? So I encourage you to check out that letter. Poor Charlie's Almanac would be another good read if you're looking for one. On the complete opposite of that, I started reading The Fund, which is a book about Ray Dalio and Bridgewater, which is a hedge fund. And man, that thing, I don't know what I expected, but that thing is a little rough. It is not good. I'm not completely done with it, so I don't want to kind of discuss it at length, but it's not good. It's not a nice portrayal of Ray Dalio or Bridgewater Associates. So I don't know. We'll see. We can discuss that on another episode. But the interesting thing, that most investors are not aware of when it comes to hedge funds do not have to report their earnings every year. They're self-reporting. So most of the time, the hedge funds that you hear from or you see on TV and you hear how great their returns are, that's because they're self-reporting. So why would you report your numbers if they were terrible, right? Why would you put that out there? And most hedge funds actually fail within 3 years. And that a lot of times comes down to leverage. They borrow a lot of money to trade, and so when things are going great, it's fantastic, and you get 60% returns, and then all of a sudden you were wrong, and now you're at zero. So that overconfidence bias and negativity, can be real. And there have been some that have been fantastic. I mean, Bridgewater became the largest hedge fund in the world, so you got to do something right to make that happen. But this book is, it is rough to say the least. All right, so thanks again for joining me. I hope this was helpful. Again, go look at NVIDIA. Go look at the AI companies. Make sure they're profitable companies, and just go look at like where this is going to where this is going to go. I thought it was so funny. On a couple of weeks ago, I talked about AI and companies that it can make more effective and like how it can change their cost structures. And then all of a sudden, McDonald's came out this past week and said they were already testing it in drive-through lanes to be able to take your order. I mean, so it's coming. It is definitely coming. So I hope you have a great week. Hope you have a good upcoming week. Don't mistake activity for achievement, and I'll see you next time. Thanks, everybody.